Are you trying to navigate the crazy US real estate market where interest rates are soaring and property prices remain high? In today's video, we're diving deep into understanding these market dynamics. We'll explore the reason for these high asset prices and what might be next. Will it get better or will it get much worse? If this is the sort of content that you're into, remember to like the video and subscribe to the channel for more insight on living globally and how to afford it. My name is Carl Pierre and welcome to my channel. First, let's look at how the real estate market reached this critical state. A significant influx of money was pushed into the market, coupled with historically low interest rates. These two factors provided cheap access to capital. This environment led to a surge in asset prices as more people were able to borrow money. The result has been increased demand across many sectors, especially housing. Understanding this backdrop is important for anyone looking to invest or buy property today, as it sets the stage for the current challenges and opportunities within the real estate market. Now, I've been investing in real estate since 2006, so I went through the housing market boom and bust and beyond that. And the most recent cycle is actually something that's quite unique. I never saw a market where interest rates were brought to near zero, and at the same time, billions and trillions, actually trillions of dollars were pushed into the hands of business owners in the form of those stimulus loans that took place during the COVID period. And the byproduct of that was that you had people who were pretty savvy, given a lot of cash, and at the same time, given access to capital at really, really low rates. So when you're able to get assets at 2%, 3% interest rates, and you've been given a bunch of cash that allows you to put money down on down payments or just outright buy properties cash and refinance out, the results are the general public is also interested in buying assets because interest rates are so low and things become more affordable. And at the same time, the businesses and the more savvy capitalists are able to do the same and see the same opportunities. And what that created was the perfect storm for home prices to go absolutely bonkers. And the reason for that is when you have interest rates that are 2 and 3%, a house that is $1 million, just use a $1 million loan for simple math, a house with $1 million loan is only going to cost $2,500 to $3,000 a month in the form of a monthly payment, maybe a little bit more because the property taxes will be higher, but you could average around $3,000 to $4,000 per million, or $300 to $400 per 100,000. Once you kind of bring rates down from, let's just say 6%, where that same money would have cost you around $6,000 a month for $1 million home. Once you lower interest rates, the same people who could afford $6,000 a month as their monthly payment are now looking at properties up to $2 million because that's going to be the same range. So if interest rates go from 6% to 2 and 3%, that $2 million house seems reasonable. And what was a $500,000 budget becomes $1 million budget. And then those people have access to the capital. So now the bidding wars start. So that's why you saw all that craziness during the COVID period where housing prices just started going bonkers because more people had access to capital, debt was cheap, and there was a limited supply of homes. So everybody has this buying power for this asset that everyone wants. And now it's even more affordable. So, I can bid up $100,000. That's only going to cost me $300 more per month. That's reasonable. And that's what happened and started to trigger this process. Also, since the government pushed so much money at the expense of the taxpayer into the market and all this extra cash comes online, it kind of devalues the value of the currency and also gives people more money to buy more goods and more services. And that starts to drive the demand, which starts to drive the price. So the fact that more money was pushed into the system devalue the money a bit, and at the same time put more money in the hands of everybody, increased demand across all goods, all products, all materials, and things got more expensive. Now things are much different from that period, and we're starting to pay the penalties of high interest and high inflation, which is something that a lot of Americans, especially younger professionals, aren't used to seeing in the marketplace. Despite rising interest rates, which are now hovering between 7 and 8%, home prices haven't seen a corresponding decline. This is due to the persistent mismatch between supply and demand alongside these inventory shortages. High interest rates haven't deterred buyers, and prices still go up. For potential buyers and investors, this means navigating a market where timing, location, and financing strategies are more important than ever. Recognizing these factors can help you make more informed decisions in a market that remains unexpectedly robust despite the economic pressures. The normal conditions are that when interest rates go down, asset prices go up, everything gets more expensive. So what the Fed has done has raised interest rates to kind of curb inflation and try to cool asset prices. But the unique thing is that nothing has really changed. I would have expected at 7 and 8% interest rates that prices would have came down maybe 15, 20, 30%, especially in some of the markets that I'm in, New York, Florida. Those are kind of balloon markets, I would say. They kind of grow whenever there's a lot of money coming into the market because they're high quality places to live. A lot of people have transplanted from New York to Florida. These sort of markets, California, they've always seen a kind of regression to baseline when interest rates are increased. However, due to high demand from an international base, as well as internally in the United States, and low supply of new homes coming online, and more people requiring housing in the United States, the prices haven't come down with these increases in interest rates. So what can you do in this particular market to kind of get ahead? And there's really not much you can do aside from being more savvy with how you approach deals, and also deciding to kind of maybe go outside of your comfort zone when it comes to the sort of assets that you're willing to buy. So let's talk about those two scenarios. How could you be more savvy? Well, the first thing that you can do is look for the distressed assets in the best areas that you actually want to be. So I've done this and I will continue to do this, but I'll try to find the ugliest, oldest house in good neighborhoods. Because what happens is that most people in America, and most people in general, don't want to take on the responsibility of the old house and renovating from, down to the studs and bringing the property back to life. That's just not for everybody. Not everybody is built for that. But if you are willing to invest a little effort and you go out there and you find that house that people aren't competing for because it's old and ugly and it's going to need a lot of money in renovations, that's where you could get the deal. Because a house like that might be priced 20, 30, maybe even 40% below market in that area because of how much you're going to have to spend and how much effort you're going to have to give. That's where the real estate flippers come in typically and buy those properties, spruce them up, and sell them to the people who don't want to deal with that headache. That's why real estate investors and flippers make money, is because they look at the assets in that way. So if you want to be more competitive and you want to participate in the U.S. real estate market and not feel like you're getting ripped off, and not feel the pressure of this housing market, you're gonna have to go after assets like that. Now, if you're not gonna look for distressed assets in good neighborhoods, then it starts to make sense to go into the not so good neighborhoods and look for really good assets there. For example, I was talking to a former tenant of mine who has relocated to Florida. She was a tenant of mine in New York. She's now down here in Fort Lauderdale, Florida. And we were talking about the market and what's going on down here. And if you're familiar with Fort Lauderdale, US 1 is a main road that runs through, I would say, like the middle of the city. East of US 1, property prices are higher, the properties are more desirable, it's closer to the beach. West of US 1, the properties are less desirable, the lots are smaller, it's different demographics. What I'm seeing and what I believe is that this road is the point of demarcation. All of the restaurants, bars, social activities, beach, all the things that people want are east of US 1. But east of US 1, you're averaging over $1 million for a single family home. West of US 1, it's much cheaper. So the people who are living downtown in the condos, in the apartment buildings, when they start to form families, but don't want to leave their area, they either are choosing Victoria Park, Coral Ridge, Rio Vista, where, like I said, you're easily going to be in the $1 million range, or you're going to go just west of US 1, where you're still walking distance to all of the amenities, and the prices are a lot cheaper. You're talking $400,000, $500,000, $600,000. What you're going to see happen is a lot of people are going to start to move into those areas, change those areas, improve the housing, invest in making them better, larger, etc. And you're starting to see that happen now. That's what happens if all markets is happening in New York City, Williamsburg, Dumbo, Long Island City, all of these places were considered dumpy, but they were close to New York City, close to Manhattan, and highly desirable. Now it's happening in the Bronx. It happened in Upper Manhattan, in Harlem, etc. This is just what happens. People will make the logical decision to go to the distressed areas or the hood because it's just what they can afford. So if you're not willing to renovate a property, your other option is to go into these kind of fringe neighborhoods right on the edge of where it's desirable to be, and sooner or later the market will follow you and you'll stand to benefit from that. As for what comes next, let's speculate based on current trends. I anticipate that we may see prices start to decline as consumer pressure increases. However, any correction is likely to be mild, possibly around 15% and short-lived. This potential dip presents a strategic buying opportunity for savvy investors who are watching the market, staying informed, and ready to act and capitalize on these changes. It's complex, but with the right strategies, there are always opportunities to be found, even in fluctuating markets like this. In preparing for when things are going to improve, or even to just buy a house in today's conditions, I would really recommend that we really look at credit card debt. What I'm seeing in reports is that credit card debt is at an all-time high. Consumers have been leaning on their credit cards to deal with the inflationary pressures, but interest rates are higher. That minimum payment is higher on their credit cards, and that's starting to squeeze them as well. So if you want to be in the best position to capitalize on the future of the real estate market, start knocking down that debt, because that's going to make you more marketable when it's time to get a mortgage. It's going to make kind of leaning into consumer debt, or leaning away from consumer debt and more into kind of hard assets that grow over time and gain value. So first, that's the first thing that you want to do, is kind of curb your credit card debt. Also really look at your living expenses. What are you spending money on that you probably can do without? Eat out less often, stop buying stuff, just start to be a little more frugal, because that's going to allow you to save more cash, minimize your debt, make yourself more credit worthy, so that when there is a broader slowdown in the market, which I already feel has started, you're going to be one of the first people to act on lower interest rates whenever they get reduced. And also you have to remember that there's a bunch of people waiting to refinance their debt, sell their properties once interest rates go down. So you want to be in a position that once interest rates do go down, and of course asset prices are going to start skipping on upwards again, that you are ready to take advantage of that. Now, if you're looking for assistance to navigate this complex real estate market and want to learn how to invest successfully, as I have, building a multi-million-dollar portfolio across 4 different countries now, check out my program, Killing the American Dream. By being a part of my program, you can learn how I approach real estate and even invest in my next deal. Visit our website to learn more so that you can start building out your own successful investment portfolio. Don't miss out on the opportunity to turn market challenges into profitable investments, and subscribe for more in-depth analysis and expert advice so that you can achieve the same success that I have and live globally on your terms.